Welcome to the Smart Investing Show, sponsored by the SEC-registered investment firm Wilsey Asset Management, a fiduciary firm owned and operated by President Brent Wilsey, who's been putting client needs first for over 40 years. The Smart Investing Show has been giving unbiased financial information for over 27 years on local radio stations right here in San Diego, providing you with fundamental analysis on stocks and investments you want to know about. Now, here are your hosts, Brent and Chase Wilsey.
Well, hello and welcome to Smart Investing Show. I'm Brent Wilsey, president of the investment firm Wilsey Asset Management. We got a great show for you here. Going to be talking about giving our outlook for 2026. 2025 is now over, so what's going to happen in 2026? Chase and I will discuss all the things that will help you make smarter investments, and we will add to that too proof that private funds aren't worth what management says they are. That's all the predictions, again, going forward for 2026. Gosh, that sounds weird to say. Chase, what do you got going on for companies? What are we doing?
Yeah, so companies we're going to look at closer today includes Marriott Vacations Worldwide. This is not Marriott International. This is actually a different company. It is still Marriott. They did spin this off, I think, a few years ago. So we'll break down that. We'll also look at Nike, Micron Technology, and Lennar, the home builder. As always, break down those fundamentals, give you an idea if we think it's a buy, sell, or hold based off the numbers we see.
Those are some great companies. I'm kind of excited to look at that. But let's talk about 2026 financial outlook. And again, 2025 was a pretty good year, unless I think you had Bitcoin, which is down, I think, for the year 7%. And residential real estate didn't really do that well either. But gosh, stocks, metals, international. It was a great year for investors. And the big
commodities, except for crude oil. But most people don't buy crude oil directly.
That's true. But will that continue in 2026? Or many times you see those high years, and then the next year you lose money. So we're going to talk about why we think that next year will be a pretty good year. Next year being 2026. So, I mean, first off, people don't realize this, but inflation and all these things affect what markets do. You know, inflation is what we see. And again, this is, you may have different opinions. I want to hear those as well. But my opinion is on inflation should be somewhere around 2 to 3%, same as they are right now. And one thing that we talked about, and it's kind of funny, in 2025, oh my gosh, the tariffs are going to cause inflation and we're going to have a recession. Some economists are saying that. That did not happen. I don't think we'll have the tariffs, if they stay the same as they are, which I believe they will, that will not cause inflation. They're not going to, up by 10%. No, they're going to stay the same. But we do have the Supreme Court in January coming out with a ruling on was the president allowed to actually do those or not.
Yeah, and that'll be interesting. Right now, I mean, based off the preliminary hearing that kind of people are forecasting, it seems like the Supreme Court will say no, he cannot implement those tariffs. But also, they've been wrong before. I know there was a kind of FTC case on the Google situation, right? People anticipated there was going to be more severe penalties, and obviously they were wrong on that. So it's not always a guarantee. The Supreme Court could, of course, come out and say, yes, the tariffs can continue. My concern is if the tariffs come out and they say no, well, then what happens next? And that uncertainty, I believe, will create a little bit more volatility in the market. But I think long-term those tariffs will find their way back in, as this administration is not going to say, oh, okay, no tariffs, fine. No, they're going to kind of find ways to figure out, I think, the tariffs, and they've been very upfront about, well, we'll find, Section 232, we'll find these different ways to implement them.
And also, too, I don't think the president, when he did this, it was just off the cuff. I know he had a legal team look at this. Can we do this? And so they have legal reasons why they did it, and that's what the Supreme Court does. They're not political. They're doing all this based on the Constitution. Was it legal or not what he did? And again, he did, or his team did, the administration, they looked at this very thoroughly, say, yes, you can do this. So and if it does come out no, that's going to be a mess unwinding that. And I don't think that's going to happen, but if it does, it's going to be a mess.
Well, I worry it is going to be a mess. I think this is where we defer. I think right now, I think it's going to create volatility in the first part of the year, because I think there is going to be that uncertainty. I think there is going to be, well, what is the next step here? Just based off the initial kind of feedback, it again seems like the Supreme Court is going to say no. I mean, that's just my initial viewpoint based off what I've been hearing. Obviously, I don't think it's like 90% no. I think right now it's like 60-40.
60-40.
I think it's going to be a lot closer. But the thing I look at from an inflation standpoint is the tariffs have already been kind of baked in. So this is almost like a worst case scenario, essentially, from an inflation standpoint, that the tariffs continue. companies have been able now to plan for that, adjust their business for it. So if the tariffs are in place, I don't think it's going to be overly inflationary in 2026.
Yeah, and these are things that we look at. And again, we're not short-term investors, traders, but we look at that. And the other thing, too, that people don't realize that January 30th, we could have another government shutdown. Well, generally January, you have the January effect. Things go up. You got fourth quarter reports coming in. Everything's good. There could be some things that maybe in January we don't do as well as we think because of what you brought up and the concern on the shutdown on January 30th.
Yeah, and I do kind of worry about the first part of the year just because, I mean, you've now had 3 major returns back to back to back for the markets as a whole. I do worry that people now are kind of almost looking for an excuse to sell.
Yeah.
And they could get that with the shutdown. They could get that with the tariffs. I mean, there is going to be, I think, volatility next year, and there is always volatility. So don't think, oh my gosh, it's going to be a terrible year next year because of what I'm saying. But I do believe there is going to be, the high possibility we have a 10% pullback next year. And I say a high possibility because that almost happens every year. So don't worry about it.
10% correction, I think, happens every 19 months or something like that. So that could happen. And the thing, too, that this brings us to is inflation. If we do have runaway inflation, that's going to be bad for interest rates, which is bad for the whole economy. Right now, the Fed's fund rate is about, 3.5 to 3.75. My opinion is I think they'll cut a couple of times, bringing the Fed funds down to 3 to 3.25. And that's really beneficial because there's about $15 trillion in short-term assets like HELOCs and credit cards and car loans and S-blocks and all these here. That's going to benefit the consumer with that half-point reduction in short-term rates, which is a positive. More money in their pocket, more money they can spend, helps stimulate the economy.
Yeah, it will be interesting to see, I guess, how much sway the new Fed chair. We know Powell's obviously not going to be reappointed.
On in May. Yeah, he's not reappointed now.
So it'll be interesting to see how much sway this new Fed chair actually has, because when you look at it, there are going to be new voting members. But based off what I'm seeing, I think there's 3 new voting members, if I'm not mistaken on that. But what I've seen is 3 or 4. They've been pretty cautious, I'm going to say, in terms of Fed rate cuts. Some of them have said, I wouldn't have cut at the last meeting. Others said, I think we're done cutting. So I don't think it's going to be an easy Fed to persuade to cut 4 times, let's say, next year. And I think your outlook of 2 is kind of what the market's pricing in right now. The Fed, based off their dot plots, they believe it's 1 cut next year. But again, with that new Fed chair coming in, they're going to be wanting more than obviously 1 or 2 cuts. So that's where I think you kind of settle around that 2 cut is a very high likelihood at this point in time. So I think first part of the year, I'd be very surprised if they cut once even.
Yeah. I think it's going to be 2 over the year and not right away. And there's people out there because, the president, he's going to pick this person, they're going to cut rates. That's just one person on that board. He cannot cut rates without the rest of the board agreeing with him. So that's an important factor to understand. That's why we think 2 is probably a reasonable one.
Yeah, and the other thing, too, is, it's a positive for people that have short-term debt. And again, it doesn't mean, we've talked about this many, many times, but it doesn't mean that's going to drive mortgage rates lower just because they're cutting rates. But it should have a positive impact on HELOCs, which we know residential real estate has kind of struggled. We know a lot of like the Home Depots, the remodeling companies, they've had a hard time. But if HELOC rates go lower, that enables people to tap some of that equity that's in their home. That should be beneficial, I think, for the residential real estate market. Not necessarily residential real estate prices, but activity occurring with remodeling and so forth. I think that would be beneficial. On the downside, though, people that are savers, your CDs, your money markets, your high-yield savings accounts, if they cut 2-3 times next year, that is going to be, 50, 75 basis points potentially that you could see in loss of interest on those saving products.
Yeah. And again, you bring up a good point about the HELOCs, because I remember the number for equity in home in the U.S. is about $36 trillion. That could change a little bit. But if just 1% or 10% of that is used, that's $3.6 trillion coming into the economy. And I think there's a lot of people, we own a company that does carpeting and flooring and stuff, and they said they've never seen it go this long before, and it's building this pent-up demand because floors and countertops and remodels eventually like, okay, it's down, I want to do this. So I think that could be a big boom in 2026 for the industry remodeling.
Well, and I think, if you're looking at tapping equity at, let's say, 7-8%, it's like, I can defer that project, maybe save up cash to do it. But again, you can tap it at and I'm not sure where the HELOC rates are going to go, but I'm just kind of saying you can tap it at 5% potentially. I think that's going to open it up for people.
Oh, yeah.
And also, too, you look at S blocks, so security-backed lines of credit. We talk to people all the time. If you're looking at doing a home remodel, well, look at HELOC rates. But if you have a stock portfolio, well, also look at S block rates.
Yeah.
So if we can get that variable rate a little bit lower, that's where I think you could have a little bit of positive activity, which should be beneficial for the economy.
Yeah, and I think consumers like, yeah, I've waited long enough. I want to redo that kitchen. I want to put new flooring in. I want to do different things. So let's move on and talk about, well, actually, I do want to talk about mortgage rates a little bit more, because what concerns me, and I know you brought it up, but what concerns me is we just did a post, I think last week, about how much debt is increasing. Not just private, but private, public, government. I mean, the debt load is just increasing dramatically. And what that means, the higher the debt demand goes up, the higher the interest rate they must pay to get people to do it. And that's where the long term comes in, because the 10-year Treasury, I see it being in 2026, somewhere between 4 and maybe a high of 5% again. And that would cause some problems for the real estate, residential market.
Yeah, I think my bandwidth on the 10-year is a little bit lower, and I think it's because Trump knows how debt works. Scott Bessent knows how debt works. I think they're going to, again, try and get somebody in the Fed chair that is going to, again, be beneficial to rates. Mm-hmm. So I think my bandwidth is potentially as low as 3.75 to 4.75 is kind of where I see the 10-year floating. There is going to be a lot of question marks over spending from the government. There's going to be question marks, again, of how impactful that Fed chair can be. I'm not saying it's the right thing to do, but if the Fed steps back in, right now they're buying T-bills. If they step back in and start buying mortgage-backed securities again, that would benefit mortgage rates as well. Or if they step back in and start buying treasuries, well, that would, of course, benefit the 10-year note. So I'm not sure, again, how much sway this new Fed chair is going to have. That's a big question mark, right, because that will have, I think, a big impact on what happens with the 10-year note. But again, if rates are around 3.75 to 4.75, I wouldn't be overly ambitious for, let's say, a 5% mortgage rate at this point in time. I think that is wishful thinking.
Yeah, I think I don't even think we'll see 6. I think right now we're around 6.3, 6.4 on the mortgage.
Somewhere around there, I believe. I haven't looked at it directly, but I think it's possible. Again, it depends. Depends what happens with this Fed chair, because if they are able to get in there, and I don't know the exact intra-workings of the Federal Reserve, but there's Lisa Cook out there who Trump is still trying to fire, right or wrong. He's able to get that person in there and appoint somebody else. If he can kind of swing it that way, it just takes a couple more people to kind of get things across the finish line.
But again, that's a short-term side.
I'm saying if they start doing quantitative easing again.
Oh, well, but even then, the government, I think right now the debt of the government is, I think, $38.3 trillion, and it's increasing. It's not decreasing, so they're going to need more. We got the Warner Brothers,
I agree with
Paramount, and everything. And I just think on the long end, we're not going to see.
But if they start doing, and again, I don't know if this is a possibility, but if they step in, there's a reason that the government was able to push the 30-year fixed mortgage down below 3%. It's because they started buying so much of that debt. Even if the government, let's say, is growing their debt at $1-2 trillion a year, well, if the Fed starts buying a bunch of that debt, well, that'll be beneficial for the long end of the curve. I think it's the wrong thing to do, but I think it's a possibility because Trump knows he wants mortgage rates lower.
Where is he going to get the money to do that for? They got to borrow.
Yeah, I got to borrow it.
Yeah, so I don't know. I'm very concerned about the amount of debt, again, in the government and private sector just going out. You got the $50 billion debt probably for Warner Brothers from either Paramount, Netflix. I mean, they've talked about that. So it concerns me. But
I'm just looking for, I think next year, come December 31st, 2026, I think the 10-year is going to be right around where it is today.
Yeah, I'm saying 4 to 5. You're saying 3 1/4 to 4 3/4. Yeah. So not a big change, but you want to be aware of it because if it does rise, that could create a buying opportunity.
Yeah.
Energy is the other thing that really can move inflation and move the markets. And right now, I don't see much change with energy. Maybe on the positive side, I do see that the price per barrel is about 58 per barrel. That could drop more. The war in Russia and Ukraine, I think we're going on 4 years for that now. Maybe in 2026 we see that settle. If we do, that'd be more supply coming to the market, which maybe we could see oil around low $50 a barrel.
Yeah, I mean, that is a tough one. Obviously, there's on the opposite side, the Venezuela situation. We know OPEC now, they used to kind of be more cognizant of, I think, of that oil price. Now they've gotten more concerned with not losing market share. And again, you bring Russia back into the fold, they're going to want more of that market share. I think you're right. I would be shocked to see, let's say, crude oil at $70, $80 a barrel. I think that'd be a big surprise unless there was some event out of left field, which we always talk about this. The Middle East is an unstable place, so it is always a possibility.
That's that black swan we talk about. You can't predict that, but that's what we try to look at. And I will say right now, nationwide, the average for gas is $2.85 a gallon. I'd be saying, wait, it's not here in California. No, San Diego, California, the average is $4.50. And I always do point out to people that, well, in Rancho Bernardo, on Rancho Bernardo Road, there's an ARCO station. They hit $3.99 a gallon. California, that's a great deal.
Oh yeah, I mean, my wife, not to knock her or anything, but she was out last night and she's like, oh, by the way, there's no gas in the Suburban, so I was kind of forced to go to the Shell by my house, and they just ream you in terms of the price. But I had my daughter with me. I was like, it's a convenience factor. I just got to do it. But it cost me $120, and now it's a Suburban, and the tank was empty.
What was you paid per gallon?
I don't remember. I just remember looking at the price at the end. I was like, man, because I knew I had to get gas anyway, so I didn't even look. I'm like, I just got to go. It was $120. Like, man, that just sucks.
Yeah, that's a lot. You probably paid probably
sure
the $4.50.
Yeah.
So, and then the job market, I think the jobs will be okay in 2026. I think we'll see unemployment about the same range. We do have some positives coming in. We do have, next year they're looking for refunds to people on tax refunds, which people love. That's about $55 billion. That will go in the economy. That's about $1,000 refund on the average is what they're looking for. So I think there will be good job market next year. Not a booming market, but I don't see high unemployment. I think we'll be, again, about the same as what we did in 2025.
Yeah, I think the interesting thing is the immigration factor is something that I don't think is really publicized very often, but obviously that is taking people out of the labor force, taking them and reducing the amount of payrolls created each month. Now, right or wrong, that's for your political opinion, I guess. But what I look at is that is slowing job growth because you are moving people out of the labor market, and that is reducing the amount of payrolls out there. So that could, again, continue to hinder labor growth. But again, we just talked about if the residential real estate market recovers in terms of activity occurring and, that creates construction jobs, I think that would be, again, a benefit to it. I think you're right. I think the labor market still, keep saying this, in an all right spot. I don't think it's going to decline next year. I think you're just going to have very low growth.
And I will say that we do see job growth in construction and so forth. I do worry about kids graduating with a 4-year degree. I think I saw something we wrote about it. I believe only 30% of graduates graduating this June got jobs in the field they wanted. And that's a problem. I mean, going to school right now, many of those jobs are being taken up by AI because they're so mechanical.
Yeah.
So the job growth will be in non-college type jobs, which is good for, I think, most people. But you may have a person got a 4-year degree and they're working as a plumber making $100,000 a year.
Possible. Yeah. But they could have avoided having all that college debt if they just went straight to being a plumber.
That is true. We've seen that happen with people, and they're way far ahead because without the debt, and they're much better off. So what do we think we'll see with equities? I mean, and I did see this too. There's a 10% chance based on the option market that we could have a 30% market drop. I don't think that's going to happen. But I think we did talk about we could see a 10% drop, which is normal. But I want, again, we do this so frequently, but I know people still don't hear it. The S&P 500 is about 40% in AI, technology-type stocks. They're very expensive, very risky. All it takes is some crazy little thing to happen. Those stocks are probably drop. And I saw the other day that the capital expenditures of the Mag 7 was now over $400 billion. They got to start getting returns on that. And these are capital expenditures. So now the depreciation comes in. So now they're going to have more expenses on depreciation. Earnings could fall. I just don't see, and AI is here to stay, but I don't see how they're going to make any money off of it in 2026.
Yeah, I think that's my concern with the S&P is I think next year the AI trade is still okay. I don't think we're going to see another 20% gain. I thought that this year, though. I didn't think we'd see another 20% gain in the NASDAQ and a lot of the tech stocks, but it occurred. I think that, again, the longer this goes, the bigger the bubble inflates, and that's my concern. And, again, you have to understand a lot of these AI stocks are very intertwined, and we finally got to a point where there was some dispersion, right? Amazon, I think, was only up 5% this year, while Alphabet was up, I think, like 50, 60%.
Because they didn't get on that lawsuit. It was amazing.
So, I mean, there was, again, that dispersion where it seems like the last few years, everything went up.
Yeah.
Largely. So I think next year there'll be more dispersion between the Mag 7, the AI companies, which will limit the S&P growth, because if they're not all going up, well, that'll, again, subdue that headline number for the S&P 500. But, I wouldn't do this and buy the AI trade. I think there is still more room to run in 2026. But, again, the higher it goes, I think the bigger the bubble and the bigger the fall.
And our portfolio did very well, and we have no technology in the portfolio. So you've got to be selective. You got to pick smart investments that will do well, not just buy it because the crowd is doing it. You think, oh, it's AI, it's going to do great. AI is, again, here to stay, but doesn't mean 2026 will be another gain of 20% of those tech companies.
And I have been seeing more people say, and Eddie Yardeni, who's a kind of popular analyst, he came out and said, I forget the term he used, but he said, forget the Mag 7, focus on the fantastic 493, or forget the exact word he used to describe the 493. But again, understand the 7 companies there occupy a ton of the index. There's 493 other companies you can look at where I think you can have better returns in 2026. And we kind of said that at the beginning of this year. I'm going to say we were pretty accurate because we were right on pace with where the S&P 500 was. I think next year that equal weight, or the 493, I think will outpace the S&P and the NASDAQ. I think at some point that reversion to the mean will occur. And, after 3-4 years of just big returns, it's just unlikely to continue in my viewpoint.
And we got to move on quickly. We'll just comment on gold and silver because they did extremely well in 2025. I got to say that is FOMO. People bought, I think, fear of missing out. I've heard somebody say, oh, gold's going to $20,000 an ounce. I mean,
better buy now.
Yeah, you got those crazy things. We continue to say, and you can comment as well, I have no clue if gold is going to be at $6,000 at the end of the year or $2,000 of the year, because it's based on what the next person will pay. And I if you're buying gold and silver, understand you're speculating because there's no reason to buy or sell either one of them.
Yeah, and just know if a commodity, anything goes up 60%, silver's up over nearly, I'm going to say 200%, don't be naive to thinking it can't go down 50%. And, we've looked at gold and silver in the past, and historically it's had these big upturns and then these big downturns as well. So just be careful. Again, if you held it, congrats, but you don't really make the profit unless you sell it at this point. And if it does go lower, it's going to cause, obviously, some problems to your portfolio.
Yeah, look at the history of gold and silver the last, we'll call it 50 years. You'll see many spikes and valleys, and we could be in a spike now, so be careful. Do want to comment, too, about private equity funds, private funds in general. A couple of funds like Blue Rock Private Real Estate Fund. I love this. They decided to go public, and were surprised to learn that the net asset value that they were saying it was worth of $24.36 a share was well above the market price when it went public that was established of $14.70. That's nearly a 40% drop on what management said it was worth when it went to the public market.
Yeah, and we actually had a client that we didn't put them in this. They were in it from a prior advisor, and every single quarter we tried to make sells, and it was always so limited how much you could get out. And then it was just, again, a big surprise to the client, to ourselves even, when it's like, whoa, it was $24 yesterday, now it's $14. So again, I think that's a microcosm of what could happen in the private market. And it really shows, again, this net asset value that these private fund managers are valuing their own funds at, essentially, is very inflated. And it could cause problems where, people try and get money out of it, and, it's not worth what you thought it was.
And I did see recently where these private funds were actually buying, I think it was like 14 times private credit, like credit card debt from consumers, like $136 billion, all going to these private debt funds. I mean, that can be risky if the economy does slow down. I mean, who knows? Was it subprime credit card? I mean, what was it? So, I mean, you can't see what goes on behind the scenes, and that's why I don't like the private side.
Yeah, I think there are a lot of things kind of bubbling up, and that's why I don't have a lot of conviction, I guess, in 2026, is because there are a lot of underlying concerns, but also, too, there's a lot of underlying positives coming as well. So there is that balance between, well, things look pretty good, but also, there are some big concerns around debt, which debt historically has been a big problem if it implodes, and it's possible that occurs again.
It's great when you're using it and it's not going down, but again, eventually you have those problems and it can implode on you, which is a problem. We got a few minutes. You want to try to hit Lennar company? Okay, let's look at Lennar. Their symbol is LEN. Then the residential construction, their short is about 7.2%. We do see a PE ratio that looks okay, 13, but that's above the industry at 12.4. Price of sales, 0.8 versus 1. We also do see that the price of cash flow, nothing there, unfortunately. Price to book value is 1.4 versus 1.3. They do have a PEG ratio of 2.3. The industry is only at 0.7, so Lennar not looking good there. Wow, earnings over the last year were down 29%. Industry was down 18%. We do see sales for Lennar were down 1.9%. That is better than the industry. That was down 6.1. 5-year earnings per share growth estimate, 7.6 for Lennar, about the same as the industry at 7.2. They do pay a small dividend. Well, maybe not too bad, 1.9%, using 20% of the earnings to pay that out. On the balance sheet, now this is different because it's a builder. Current ratio very high, 12.6 versus 8.4. I think that's because of deposits, some other accounting issues there. Debt to equity very good, 0.2 versus 0.4. Net profit margin checks in pretty good too, 7.7 versus 8.2. Return on equity 11.8, not as good as the industry at 14.2. Free cash flow for Lennar is a negative $713 million, I believe that is, versus a positive $883 million for the industry. What about going forward, Chase?
As a current price for Lennar, again, their ticker symbol LEN, it's $102.97. 52-week range. It's been a difficult year for Lennar. The low here, $98.42. So again, right around that current level, while the high is $144.24. Year to date, the stock is actually down close to 25%. The stock, though, has done well over the last well-ish over the last 5 years, about 35%, but over the last 10 years, it's up 144%. So again, you really had a good, I'm going to say, 9-year return, and then the last year, it's really kind of been bogged down. And that's, again, what I'm talking about with the AI trade is just because something did well in the past doesn't mean it will do well going forward, as we've seen with the home builder Lennar being down about 25% this year. Now, going forward, that's the big question. Should you be buying Lennar after the dip here? Going out to November 2027, I see estimated earnings per share of $9.87. It gives it an attractive target sell price here of $163.84. Trades around 10.5 times future earnings, which is a decent valuation there. But the big concern you have, the low estimate, $7.42. The high estimate, $14.11. And they're looking for earnings growth of about 39% with the cost of labor, the cost of materials. I don't know how they could expand margins by that level.
Yeah, it's just, and again, we talk about interest rates as well. I don't think that's going to do well. And I do see that the estimate is down 17% from 90 days ago. So it looks kind of attractive, but I don't think it's the time. I don't think 2026, you should be buying a builder.
Yeah, I think I got to be cautious there.
Yeah. All right, we're going to take a quick break here. When we come back, we're going to finish up talking about Micron, Nike, and Marriott International. Stay with us. We'll be right back after the break. All righty, welcome back to the Smart Investing Show, and this is the part of the show where we talk about financial planning. For that, we turn to our financial planning expert, Harrison Johnson, the CFP. Harrison, you may be entitled to spousal Social Security. This is something that really confuses people because of divorce and everything else. How does this work?
There's something specific that I want to bring up that I've seen a couple times now. Now, a spousal benefit with Social Security means if you have a spouse that worked, paid into Social Security, if they are eligible for something, then that means you as a spouse are potentially eligible for something as well. However, earlier this year, there was something called a government pension offset and a windfall elimination provision, but this is specifically more about this government pension offset. It was a rule that said if you had a spouse that worked and paid into Social Security, received Social Security, if you had a job where you worked and earned a pension and did not pay into Social Security, like if you were a teacher and are on CalSTRS, or if you were a firefighter, or a police officer, or something like that, this government pension offset reduced any spousal benefit that you would be eligible for from that Social Security working spouse. But that has been removed. And so the thing I want to bring up is I've seen this a couple times where you might have a couple that retired a couple years ago. One spouse is on Social Security. The other spouse is receiving their pension. Now, because of that repeal this year, that pension earning spouse is entitled to receive a Social Security benefit from that working spouse because that rule no longer prevents it. But the Social Security Administration is not aware of that happening, so that person needs to go and apply with Social Security to start getting that going. And that might be $1,000 to $2,000 a month that they're not receiving that they are now eligible for. So it's something that's very important. If you have a spouse that is receiving Social Security and another spouse that is receiving a pension, and if that pension-earning spouse, when they originally applied, if they're not receiving anything from Social Security, you potentially are eligible for it. You need to reach out to Social Security as soon as possible and see if there's anything that you're not collecting.
And I'm surprised about this because I think it's now 8 years away when Social Security is supposed to be a pay-go system where like what goes in is what gets paid out. This seems like that's going to cause us to get there faster.
Oh, it absolutely will.
Yeah.
So part of me is like, maybe we don't say this because, but you're right. So the logic behind this rule was right now, if you have a spouse who never worked at all, never paid into Social Security, but they're married to somebody who did, that spouse that never worked is eligible for a spousal benefit. And that's always been the rule, or it's been in the rule for a very long time. With this government pension offset, it said, okay, well, even though this spouse, never paid into Social Security and really should be eligible for a spousal benefit, we're going to reduce that because they have this pension.
Right.
So why is that person that had a job and paid into a pension being penalized when a non-working spouse isn't? That's kind of the reasoning for it. But the fact of the matter is it no longer applies. So I know that there's people out there, because I've seen it, where they are not collecting something that they're now eligible for.
Yeah,
And
but
Chase,
if you're
I see
working,
you got like you're looking like what?
so if you're working and paying into Social Security though as a spouse, then obviously your spousal benefit might be less, right? Or you're going to claim your own benefit.
So if you worked into Social Security, your own benefit potentially is going to be higher.
Yeah,
But
if it's not, then can you also collect off your spousal benefit?
so you collect the higher of the two. So
Okay.
if you worked and your spouse worked and both paid into Social Security, when you go to apply, you're what's called deemed to be filing for all benefits you're eligible for. So that means if your own benefit is higher, you'll get that one. If it's lower because you had low earnings or low earning history or whatever, that in your spousal benefits higher, you'll get that spousal benefit. So that's automatic.
Yeah, because the way I look at it is like, well, but if you're in the pension system, you kind of get benefits. I mean, obviously, our wives worked in the CalSTR system, and it's like, well, you're not getting Social Security, but you are getting a nice benefit on the other side for not getting that Social Security, and it's an amplified benefit. So to me, it's double dipping.
Yeah.
That you're getting the better benefit, and then also you're getting the Social Security benefit. So, I mean, obviously, it's not for me to decide on the political front, but again, my big concern is, as you brought up, what are we going to do with Social Security?
It is double dipping. But if my feeling is if you're excluding a spouse because they worked and paid into a pension, you should also exclude spouses that stayed home and didn't work at all. Yeah. And so right now, the spouse that stayed home is eligible for a spousal benefit. They've always been. So this is just leveling that playing field. Now, the bigger question is, what are we going to do? Because we're running out of money. I mean, that's a whole other conversation.
That's a big problem.
That's a big problem that needs to be addressed, and something needs to change with that as well. No one wants to talk about it because it's not popular. Okay, well, we either have to increase taxes on something or we have to cut benefits on something or some combination of there in between. Nobody wants to, address that. They're talking more about, well, let's just, make it more tax-free or, give more benefits or increase benefits. We're going to run out at some point, and that, that's going to, the longer that gets delayed is going to make it worse.
My viewpoint is at this point in time, the most likely scenario I see is just you flip the switch and you allow it to create deficit spending.
Yeah.
That's probably what's going to happen. Right now, under U.S. law, the federal debt cannot fund Social Security benefits. That's the way it's written right now. So that law would need to change, but that's probably going to happen because if we get to a point where that trust fund is essentially empty, yes, there's people still working. So if you have a W-2, if you're self-employed, you're paying into the system, but that's not enough to pay out all of these benefits, especially with, the repeal of this windfall elimination provision, government pension offset. So, we're going to run out sometime in the 30s, probably the early 30s, and there's going to be needed to be changes.
Yeah, that's going to be a problem. And then what I said in the beginning, too, was even divorced spouses, even though they're divorced, they would still get this as well.
Let me think. So...
And I know I cut you off.
Yes,
Yeah.
yes. Yes. So if now, depending on the length of the marriage, if the marriage, I think you had to be married for 10 years, if I remember correctly, then that means if you are divorced from your spouse, you can still collect a spousal benefit off of them. So if you were collecting a pension and not receiving anything from Social Security, if you're divorced, you potentially can go apply and now collect a spousal benefit from your spouse that you divorced at some point. So yeah.
Wow, crazy. They just keep draining that fund, and then like, oh, we have no money. What happened? Yeah, just
and I mean, the next presidential cycle is what, 2028. That person, in theory, would be in office when the Social Security Trust Fund runs out.
They are going to need to address it.
Yeah.
I mean, whether it's 32, 33, 34, depending on, how it's kind of functioning. But it'll be in the later stage of that presidency, so they're going to have to deal with it.
yeah,
So that'll be interesting to see how that next presidential cycle goes and how they're going to attack Social Security. And that's why I think at this point, nobody wants to cut benefits. Nobody wants to raise taxes. So I think it's just going to be another debt that is accrued and adds to our national debt.
we talk about not cutting benefits, but this kind of added more benefit, is what you're saying.
It increased benefits.
Increased benefits.
Yeah. So increased benefits, increased outflows from that trust fund, and it's been slowly depleted for quite a while now. So I think we'll have increased taxes. I mean, the same thing is happening with Medicare. The net investment income tax was put in place quite a while ago into the Obama era. So that was a tax on investment income to help fund Medicare. We could see something like that where it's not necessarily a payroll tax. It could be investment tax or wealth tax. Who knows? I mean, who knows what politicians will come up with.
Well, Harrison, next week, bring some good news. Okay.
All right. I'll make sure. Well, this is good news if you're if you can qualify for that. Yeah.
But I'm thinking about the millions of taking Social Security that it's running out. So, but thank you very much. Again, that's Harrison Johnson. He is our financial planner. He is a CFP. If you want a free consultation with him, give him a call at the office, 858-224-0004. Again, that's 858-224-0004. Or go to the website, smartinvesting2000.com. Again, that's smartinvesting2000.com. You get that free consultation as well. And he has a lot of things he covers. If you listen to the show on a regular basis, you know he covers many different things. Kind of caught him off guard in that one question about the divorce, but he thought about it. Yes, he had the answer. So, all right. Should we move on to, I was going to move on to Micron. Is that what you want to do, Micron?
Sure. Let's do Micron.
Micron Technology, they're in the semiconductor industry. Only 2.2% short on the float side. PE ratio is high at 27.1, but this one I kind of talked about next year. The industry is at 47.9 times earnings. That's the average, not the highest. That's the average. Keep that in mind. Price to sales 7.6 versus 13.6. Price to book value 5.5. Industry higher at 11.6. We do see price to cash flow is 14.2 for Micron versus 36.4. And the PEG ratio for Micron, very good, 0.3 versus 13.7. So again, it based on this high-priced industry, Micron looks pretty valuable, reasonably valued at this current level. Now, we do see earnings over last year were up 201% versus 71% for the industry. Sales increased by 45.4% versus 53%. The 5-year growth rate for Micron, 26.3% versus 29.6%. And this is why you're paying such high valuations, because the expected growth, not the guaranteed growth, but the expected growth. They pay a small dividend, 0.2%. Don't know why they do that. They use 4.3% of their earnings to pay that out. Look at the balance sheet. We got a current ratio, very good, 2.5. Not as good as the industry at 3.5. Debt to equity, 0.2 versus 0.3. That is positive. Net profit margin, 28.2 versus 28.9. It's a pretty good profit margin for both the company and the industry. Return on equity, 20.3. That's good, but the industry's at 58.9. Free cash flow, $4.6 billion. Sounds pretty good, but the industry is at $45.8 billion, and I don't know how it's that high. That seems a little bit strange to me, but that's what the numbers show here. Chase, what do you got going forward?
Yeah, so I mean, I was just kind of looking at Micron here, and I'm blown away with the return. I'll get to that in a second. But current price for Micron, ticker symbol MU, $284.58. I say I'm blown away because the 1-year return, 233.5%.
Wow.
Now, that I think is better. Actually, I know it's better than NVIDIA this year. It's better than Broadcom. It's better than AMD. I think this
I think it beats almost everybody.
Yeah, I think it's potentially the best chip maker of the year. And you look at the 52-week range, the low here, $61.54, and the high, $298.83. I mean, Micron, they did have a huge increase after reporting earnings. They jumped more than 11%. And, I mean, they did well. There's no denying that. I mean, the things are going very, very well for the company. And I'm surprised by this. But you go out to August 2027, they do report on a fiscal basis. Estimated earnings per share, well, they're $38.48. So it gives you a target sell price of $638.77. It actually trades at a forward PE multiple of about 7.5, 8 times those earnings. The problem with Micron, it is a very variable earnings picture for this company. Yeah. If you look back at 2022 as an example, the company had about $30 billion worth of sales. 2023, they fell to about $15 billion.
Yeah.
So, I mean, things can move very quickly for this company. And it is also very, I'm going to say, fixed expenditure heavy. So their expenses are fixed expense heavy. So not as many variable expenses, more fixed expenses. So when sales fall, earnings fall very quickly. Give you an idea of those numbers. 2022, the company made about $8.7 billion worth of profit. 2023, when those sales declined, they lost nearly $6 billion. So, I mean, that's the issue with a Micron is I think when things are good, they're really good. But when things are bad, gosh, they are really bad. And are we near the end of this memory chip cycle? Potentially. And when things fall, I think that stock will fall pretty quick.
And a couple of things. You mentioned the $600 price target, which is like, wow, I'm going to go and buy this, based on $38.48 of earnings. 28 analysts. The range is ridiculous. A low of $16.85, a high of $48.06. I mean, that means that number it could vary. And again, 28 analysts is a lot. And I also noticed over the last 90 days that estimate has increased 119%. Yeah. So there's something going on with this company.
Oh, they reported great earnings and they gave a huge forecast.
So and that's why the analyst bumped it up because even what is that? A month ago it was like $23, now $38. So they're giving this great forecast. We don't follow the company, so I don't know what they actually do. We have known about this company for years, and you're right, their earnings are all over the board.
Yeah, and my concern is, as I said, 2022 to 2023, when you look at those numbers, I'm willing to venture when things are really good in 2022. Many of those analysts are like, yeah, things are going to be great next year too. I don't think many of them thought it was going to be that big of a fall the following year. So, I mean, that's just the concern I have with Micron. I'm going to make this statement. I don't think I'd ever buy Micron. And the reason being, until they had more consistency in that revenue and the earnings, it's just too hard to value because you almost want to be buying this thing when it trades at 50 times earnings and selling it when it trades at 8 times earnings. And what I mean by that is it's so cyclical. Generally, that stock price is going to be depressed, and that's when you want to buy it. But that's when the earnings don't look as good, and then it turns around and goes higher. It's just too hard of a gauge to kind of derive our formula with the future earnings on because the earnings are, again, just so variable.
And maybe the estimates are just too optimistic, I believe. And could this be an Oracle situation where Oracle went up, 50%, then it fell 40%? I mean, it's just, you know, when it comes to an investor, you want to kind of avoid these companies because they'll drive you crazy. Even though the numbers look pretty good, they're all over the board.
And again, I was blown away by this. The 10-year return real quick, 2000, 36%. So, I mean, it's been a great performer. Will that continue? I'm a little skeptical of that.
Yeah. Well, congratulations if you held it for 10 years, which most people do not.
Yep.
So, all right, let's move on to another one that was kind of a loved company, I think, just a year or two ago. We're talking about Nike. Their symbol is NKE. They're in the footwear and accessories industry. Short is only 3.9%, about 83% institutional owned. PE ratio, and the stock's pulled back. Even with that, the PE ratio is still 37.4 versus 29.1. Price to sales are high, 2 versus 1.6. Price to book value is 6.7 versus 4.3. Even price of cash flow, 26.8 versus 21.2. They do have a good PEG ratio, which surprises me. It's 1.8 versus 13.2. That's the only positive because this company, even with we'll talk about Chase more, talk about the pullback, how much it's been. I know it's been huge. Still, valuation ratio is very expensive. Over the last year, here's a problem. Earnings were down 39.8%, industry down 5.3%, sales down 5.2 versus 2.3%. The analysts, and you know, these are estimates, and we do give them, but sometimes you got to question them. They had the 5-year earnings per share growth rate for Nike stock, their earnings, 12% 25.4%. That is just a huge number. It surprises me. They do pay a dividend. Now the stock pulled back. The dividend is 2.6%. They use 82% of their earnings to pay that out. Look at the balance sheet. Current ratio 2.2. That's the same as the industry. Debt to equity 0.8 versus 0.7. Net profit margin for Nike is 6.2. That's above the industry at 5.5. Return on equity looks good, 21.5 versus 21.4. Free cash flow for Nike is pretty good. We do like companies with good free cash flow, but Nike is $3 billion, about double the industry at $1.5 billion. What do you got going forward, Jace?
There's a current price here for Nike. Again, their ticker symbol NKE. It's $63.92. And he said, they were kind of in favor a year ago. Actually, time just flies. They really haven't been in favor since 2021. 2021 is when they peaked around $180 a share. That was at the end of the year. But really, since then, they've kind of been on a steady decline.
And I thought that was like a year or two ago, but it was 180 was 4 years ago.
Yep. Yeah,
Wow.
The end of 2021. And then the 5-year return, obviously, now we're at about that 2021 level. 5-year return down about 54%. Year to date, the stock is down about 15%. Elliott Hill, the new CEO, he definitely has some tasks, I guess, to say the least, to get this going in a different direction, because it's really been a struggling, to say the least. Looking at valuations, though, it is still not overly appealing. You got to May 2027, estimated earnings per share here, $2.35, gives you a target sell price of $39.01, still trades at about 26 times future earnings. The reason, though, this could be appealing is this the bottom for earnings for Nike? Looks like this year earnings are estimated to fall about 28%, but then next year they're expecting earnings to grow about 50%, so they could be now growing off a very low base and could see large earnings growth to maybe justify a higher multiple. But, it's I'm going to say still some lofty expectations for a company given that multiple.
And the reason why we're so conservative when it comes to buying these high flyers, you didn't point out the 10-year return. Did you see the 10-year return?
No, I didn't point that out.
14.7% over 10 years. And this was like, oh, it's Nike. Oh, you can't go wrong. That's
But your first 5 years, you were probably up close to 100%.
Yeah. And so, no, I want to sell it. This is why we say don't base holding on to it just because it's done well. Because, again, you probably had a period where you were up quite substantially, and now over 10 years, up, well, less than 15%. So this is why it's so important to understand the business. I think they are having trouble with the tariffs because of China. I think a lot of the products made in China. Again, we talk about understanding the business. When I saw this drop, I said, hey, maybe we should look at buying this. Still.
A couple of things to add to on Nike. They did report earnings, and they fell after reporting earnings. It was kind of a little bit of a surprise because they had better than expected earnings and revenue, but the thing that seemed to weigh on them was sales in China dropped by about 17%, and that's still a decent-sized market for them, I believe. So, there is some concern there. The other thing, too, I grew up loving Nike. When I was playing football, I always wanted Nike. We were sponsored by Adidas in high school, or we had to kind of get Adidas. Right. So I guess we weren't really sponsored by Adidas. You're not sponsored in high school at that point. But we had to get Adidas, and it's like, man, I want to get Nike. So Nike had that kind of brand affiliation where like, man, Nike is just kind of on the pedestal. But now things have kind of shifted. If you look at, OnCloud, for example, that's the new shoe. And I'm going to use my personal experience. I used to always buy Nike. Well, my household this year, my wife wanted OnClouds, and she got me 2 pairs of OnClouds. There was no Nike in the household, which is very different from, I guess, years ago. There's been new entrants. You talk about Lululemon. Nike didn't really have to battle these other athleisure companies. I think the pie has gotten larger, but there's been more entrants into that pie, which I think has made more competition. And I think Nike is kind of not really the cream of the crop like they used to be.
Well, competition is very hard for businesses. That's why we don't like to overpay for business. Yeah. We want to have good earnings, low debt, because, again, competition, it happens all the time. That's what's great about a capitalist society is competition can bring down prices. I don't even know where to buy those OnCloud shoes you're talking about, but I do know they're a competitor, and I don't see Nike ever coming back the way it did. Now, maybe, what was the target sell price you came up with? What was it?
It was $39.01.
So not even close. You're not even close. So even, and I was going to say, even if it goes up, target sell price to 80 or something, I still think they have a tough road ahead. Competition, who knows? We talked about the tariffs at the beginning of the show. What if they stay there? It's a tough road for Nike.
We've done well buying retail in the past, but at attractive valuations, because you generally want to buy these companies when they're going through a restructuring, which Nike is. But if they had valuations that were more attractive, I think I'd be all over it. But
Yeah.
again, the concern is the valuations aren't that attractive. The last thing I know we got to move on here that I wanted to add was Tim Cook did actually buy about nearly $3 million worth of Nike, which gave a little bit of lift to the stock.
Right.
And he's on the board. That's why he bought it. It's not just kind of random, hey, I like Nike. But I do have to point out, obviously, Tim Cook is worth a lot more than $3 million. So I don't think it really moves the needle in terms of his investment portfolio.
Yeah, he's a
He's got
billionaire.
to be worth $1 billion at least.
Yeah. So for him to spend $3 million, like, okay, we'll just throw a few
just
dollars at
quick Google search says $2.6 billion.
it. Okay, yeah. So a $3 million investment for him is, like the average person doing maybe $20. So, all right. Well, let's move on here. Let's move on to the next company we're talking about is where is it here? Marriott International, or no, Marriott Vacations, I guess.
Yep.
Symbol is VAC. And this came up. I saw this in a recent financial publication that it just looks like it's on sale. So I want to kind of give this to our listeners as well, kind of take a look at it. We've not done a deep research on this yet. But a Marriott Vacations company, symbol is VAC. They're in the industry of resorts and casino. Short is about 8%, not high, but definitely not low. Now, what I liked about initially caught my attention was the valuations look pretty good on it. The PE ratio is 12.6 versus 25.9 for the industry. Price to sales 0.5 versus 1.4. Price to book value 0.8 versus 3.1. And price to cash flow is higher, though, 19.8 versus 7.4. The PEG ratio, very good, 1.3 versus 4.5. Now, over the last year, unfortunately, their earnings fell by 13.1% when the industry was up 26.1%. We do see sales for Marriott Vacations did climb by 4.2%, not quite as good as the industry at 5.5%. And they do see 5-year growth in the earnings, about 7.6% below the industry at 8.7%. Now, they do pay a dividend. 5.6% is that dividend yield. They use 64% of the earnings to pay that out, so that looks pretty good there. We do see on the balance sheet, current ratio 3.7 versus 1.3. Debt to equity is 2.3 versus 6.2. And we kind of talked about this briefly, Chase. That sounds very high, but this is a timeshare company. We're not sure how the real estate is, how the debt works and stuff. So this is the research you have to kind of do.
Yeah, just real quick on that point. I mean, they do develop, sell, and then finance the timeshare interest. So the thing I'm not fully understanding yet, and they do own, it looks like, a lot of real estate. So, I mean, to me, that's a positive. But when they're doing the timeshares, I'm not sure how they carry the timeshare on their books, because if you have, let's say, a timeshare and you own that timeshare, well, that might be a liability on the books.
Yeah.
So it might distort that debt to equity ratio as well. So there is more to understand with this balance sheet, because it is not just, I'm going to say, a simple balance sheet.
And it could be like car companies
Yeah.
where they carry the paper for the debt when you buy a car. Maybe that's the same thing here. But again, it's something that you want to look at because it doesn't look good. Again, you got to understand the numbers. They do have a net profit margin 3.4. That's below the industry at 5.5. Return on equity is 7 versus 30.5. I would like to see that higher. Free cash flow is only 63, million versus 778 million for the industry. Just got some research to do. What do you got going forward here, Chase?
I mean, it looks interesting. Marriott Vacations Worldwide, again, their ticker symbol VAC. Current price $57.67. 52-week range low $44.58, and high, like you said, it's on sale. $91.18 is the high. The 5-year return here is down about 58%, and over last year, it's really suffered, down about 36%. But this is where it gets interesting. You go out here to December 2026, estimated earnings per share is $7.07. It gives you a target sell price of about $117.36. It trades around 8.5 times those future earnings.
Yeah, and those earnings, there's 11 analysts. High is 847, low 545. I don't really like seeing that. I wish they were tighter. I do know when I was looking at this, what I was reading was that the other ones, like from Hilton and Wyndham, they've actually done very well. But the Marriott, they don't have a CEO. They're in the middle of a remodeling. So this could be a buying opportunity. But again, a lot of research to do here on this.
My big question is, again, I haven't looked at the real estate footprint, but what real estate do they actually own here across the country, across the world? Because the market cap on this company is now about $2 billion. I almost wonder, are they at a point where the real estate is exceeding the value of the market cap on the stock? Because that would be, again, in my viewpoint, a buying opportunity, because that real estate is tremendously undervalued. They could liquidate the whole portfolio, let's say, and have, a market cap, let's say, of $3 billion. I don't know what that is, but if the underlying real estate is substantially more valuable than the market cap of the company, that's got to be a room for increase in that stock price.
When I was also reading about it, it did show that people think, oh, timeshares are for old people. Actually, now the average age is about 39 years old. So people are saying, hey, this is a pretty good deal. But to answer your question, too, and I'm kind of wondering, because as a timeshare owner, you own a small piece of that.
Yeah.
So who owns the real estate? Each individual owner? Marriott?
Well, that's what I mean. It could be a little bit problematic on the balance sheet, right? Well, technically, Marriott carries the asset of the company, but then also the liability to the timeshare holder. So
Right.
there's some question marks.
Yeah, you got to be careful. That's why you got to do the research. That's why it takes us 10, 15 hours, 20 hours before we buy something. All right, thanks for listening to the Smart Investing Show. It is for information purposes only. It should not be used as investment advice. If you'd like to discuss in more detail your investment needs, have other investment questions, feel free to call myself, Brent Wilsey, or Chase Wilsey at 858-224-0004, or go to the website smartinvesting2000.com.